Hello everyone, this is Abhay Agarwal from Piper Serica. Today is quite a relevant day to have a discussion on this because the strong reaction yesterday to the Fed's announcement of a rate cut by the global markets, including the Indian market, makes it important for us to talk about why that severe reaction took place and what is the near term and the medium term looking like for global and Indian equity markets over the next year. As we get into 2025, I think it is very important for us to reassess what are the global forces playing out in favor of India and some that are not in favor of India to come to some kind of a portfolio strategy. And we will also share the portfolio strategy stance in terms of our model portfolio that we are following at Piper Serica. So let's start with the reaction to the Fed rate cut. Now the rate cut was as expected. There was no surprise there, and the Fed did not disappoint with a rate cut. However, what was a big negative surprise for the market participants who were assuming that Fed will stay on a very smooth gliding path to a rate cut were disappointed, and not only disappointed, but I think bordering on a shock because the Fed came out and said instead of 4 rate cuts, there will be only 2 rate cuts next year. Now, you have to remember that this communication of Fed is based on the current data that they are seeing on inflation and the economic strength in the US. Now, if this does not translate into a heating up of the economy, the Fed in the next meeting may come back and re-guide to a smoother glide path for rate cut. So one needs to understand that this is not a cast in iron strategy by the Fed. Fed is a governing body, a federal bank that reacts to the data that it is seeing. And I think some bit of overreaction in the market that we have seen where the Nasdaq fell more than 3.5% over a single session. The Dow Jones fell 2%, the S&P corrected by 3.5%, was also due to the fact that the market was looking for a reason to correct. The market in the US and the markets in India and other developed markets have run up to an extent that some of the valuations are absolutely unsustainable. And the only reason that these markets have been running up was in expectation of a very low cost of capital environment that becomes more and more favorable to investors that are looking to arbitrage by borrowing at a cheap rate and investing in risk assets to make an arbitrage. Now, some bit of it, or actually a large part of this global asset market rally has been driven by this liquidity inflow into both passive funds and active funds. So what does this Fed rate decision do to global markets and more pertinently to the Indian stock markets? So the way we see it playing out is that India is and has been and will be for some point of time a fairly insulated market, though there is a sentiment-based impact, and we have seen FPI selling been fairly consistent over the last quarter, slowing down now. But if you look at what has been going on, the FPIs have clearly been in a mood to take out money from the Indian market, which they probably believe is expensive based on the last quarter's earnings, and redeploying it into markets that have more momentum. And that has led to a rupee depreciation of rupee is now at 85 on its way to probably 86. The fall from 84 to 85, I think, has been sharper than market participants expected because they would expect RBI to come in at some point of time to support the rupee. But that has not happened. And I think RBI is happy to let it play out in the natural course of depreciation rather than interfere too much. Because you also have to remember that US dollar index went up almost 2% overnight after the Fed rate decision and is at almost 108 now. And this is a very sharp appreciation of the US dollar over the last 6 months that we have seen, where at the index level, it has gone from 102 to 108 and it is not stopping. So you look at some of the other bigger currencies like the euro, yen, and Canadian dollar, Aussie dollar, pound sterling, they have all depreciated sharply. So the rupee depreciation by itself is not a surprise because it is still doing pretty okay on the weighted foreign currency basket basis. But it is against the US dollar that the depreciation is quite sharp. Now, what happens to the Indian stock market? Where are the opportunities? Now, if you look at the Indian stock market, India has always been a bottom-up stock picking market. That's where the biggest returns have been over the last 30 years. And we don't see that changing because there are new sectors that are emerging in India. There are new opportunities that are being created a lot because of domestic consumption demand and also driven by the government to make India a self-sufficient manufacturing country rather than focus too much on imports of items that can easily be made in India but were never made because our industry never got the support to scale up and create the kind of volume-based manufacturing that global manufacturers have got. I think what we are seeing is that there is a lot of support from the government right now to industries through its PLI scheme or through subsidy of cost equalization, customs duty on imports, even banning imports of some items to make sure that we are not overtly dependent on foreign countries, especially China, which is a global powerhouse in manufacturing. So if the Indian companies do not get this support, I don't see any way that they will be able to compete against the Chinese companies that have already got massive price advantage because of their volume of production and also low cost of capital and support from their Chinese government. So in that environment and in a situation where rupee is depreciating, in an environment where our trade balance is already higher than we would like it to be because of import of crude oil and gold, it is very important that we develop our own industry that manufactures semiconductors, that manufactures APIs for pharmaceuticals, that manufactures complex electronics or even simple electronics. Also, it is very clear now that India has underinvested in its defense industry, defense procurement for almost 20 years. And now there is almost a panic level urgency at the government to procure not only armament, but also improve communication technology and technology that is required by our defense forces. So we are seeing opportunity space getting created in defense sector for private players that can come and fill that gap. And then there are emerging sectors in mobility, both in electric vehicle, electrification of mobility, and also railways, which has been again an underinvested segment that is now finally getting its due. So I think again, great opportunity for young Indian companies to come and provide technology support and technology solutions to railways. I think this is where new opportunities of multibaggers will come in India, that these are the companies that are replacing imports for the entire country, and as a result of that, they have government support and they have a ready market to do that. And these companies are learning technology development at a very rapid pace. And we are seeing early signs of US and European companies, large companies that want to target the Indian market, come in and not only sell products, but also engage in discussions around technology transfers. I think that is something that is very important for India's GDP to grow, that we are able to do this technology transfer and then make in India, drive employment and drive domestic consumption. So that is where our focus is, that rather than getting lost in the generic large cap space of buying companies that have already become multi-baggers, and there's nothing wrong with them. I think they will all do well. But where we see opportunity to make multi-baggers over the next 5 years, 10 years is in emerging spaces. And I think in India is a market that once you get the theme right, all you have to do is pick one or two companies in that space and be patient while these companies generate their returns. We have done that successfully in the past by identifying EMS as a theme, where we had invested in Dixon, which is almost a 20-bagger for us now, or other companies like Amber. And there are plenty of opportunities. All you need is to have a very strong on-ground research and an eye to the ground, ear to the ground to make use of these opportunities. So to conclude this episode, what I would like to say is that this global volatility, which leads to sharp price corrections and investor nervousness, is actually a very good friend of long-term investors, because this is how they get opportunities to invest in high growth companies at very fair valuations. The problem with high growth companies is that a lot of times they are overpriced, and only in these sharp market corrections you get an opportunity to invest in them and then benefit from that price correction. So that is where our focus is. I don't think long-term investors should worry about sharp market corrections. In my experience of investing over 30 years, I've always seen that such market corrections are actually a friend of long-term investors. The panic subsides, and then at the end of the day, market rewards earnings. And if the earning growth kicks in, and as an investor, one has identified it, that is a great way of making money. So to conclude, we are very positive on India as a long-term investment horizon. I think I can go out on a limb and say with a lot of confidence that India is the country that will generate the highest return for equity investors over the next decade. But the investors will have to be very careful in picking the right theme and picking the right entry point. I think if they can get this right, and with a lot of patience, India is a market that will surprise positively a lot of global investors through the returns that it generates. So let me conclude by wishing all our viewers a very happy Christmas and New Year, and then we look forward to coming back to you and sharing our views in January. Thank you so much.